Hello, hello.
Hey Pete, how
All
are
right,
you?
we're live. We're live.
Right.
Oh, there's supposed to be. Oh, there it is. Um, could you see? Hold on. Start. Okay. Could you see that?
All right. Yep, I'm in. How are you?
Great. I'm glad it's Friday. Happy Friday.
Happy Friday to you as well. Me too. It's been an interesting week. Good week
So,
though.
so hopefully we can get a couple people here. I don't know if they logged in. There's a couple people logged in.
Okay.
Sorry for the late start, guys. Technical difficulties. Um, Technology, it
Yeah,
works. It works only when it wants to, right?
of course, especially on Fridays and
Yeah,
Mondays.
yeah, yeah. So, this is recorded. So, for any people on the webinar, there's a chat feature that you can ask some questions, but certainly want to talk about something very important. Obviously, first time home buyer, and what resources are out there, and kind of what to know, what's available. And I think a lot of people don't get started because they don't know how to get started. So why don't you go ahead, Kristen, introduce yourself? Well, real quick, I'm Pete Ferrara with Homebridge Financial. I'm happy to partner up with you, Kristen, to present hopefully some good information. It'll be recorded and you can share that with all the people that weren't able to attend. So give us an introduction of yourself.
Hi everyone. I'm Kristen Rusev. I'm a real estate agent here in the Illinois area, and I am with Classic Realty Group, and I'm here to help educate clients on the options for first-time home buyers. And so I'm happy to partner up with Pete on these educational webinars to try to spread as much knowledge as possible. So that's what we're doing today.
Excellent. So the weekend is coming up. Hopefully there's some folks that want to get the process started and learn how to become a homeowner. One of the things, and we'll talk some specifics later. I truly believe that, if you can't buy a home today, next month, certainly in 6 months, 9 months, 12 months, almost everything is fixable. And we'll talk about some of the things, some of the challenges, and what folks can do to prepare if they're not ready right now, which is also interesting that there's a lot of people that don't think they can buy and continue to rent, but they actually can buy, right? You've probably come across that before.
Yeah, all the time. All the time.
So let's see if technology works here. Yay.
Okay.
It did, the screen. So obviously thanks for joining us. We did the introduction. I already said ask any questions in the chat box. We'll do the best to answer those. So we're going to talk about the main keys to qualifying for home ownerships. We're going to talk a little bit about credit. We're not going to get too in depth about how you fix everything, but just know that stuff is fixable and what the main factors are that affect the credit. We'll talk about why you should use myself and Kristen in your journey, and then we just want to give you the information so that you can make a good decision if you would like to purchase. So obviously, interest rates, look, we know that in the last 2 years, they were definitely in historic lows. They're still actually low compared to, I've been doing this 28, 29 years. I mean, interest rates have been, in the 13s, 14s, certainly we're not going to see double digit rates. But rates are right now, I would say they're in the fives. Nothing that they haven't been before. As little, I think it's been 4 years ago. I believe this is kind of where rates were at about 4 years ago. So if I look back, so it wasn't that long ago, but people have very bad short-term memories. We all want the 2.5, 2.75 rates, but let's just understand, what you can afford and all that. We still have the low down payment stuff. We have 3% down payment conventional loans, which is a nice thing. And we'll talk a little bit about down payment assistance. That's still available, especially in Illinois. We've done down payment assistance for like 20 years, so we know it in and out. So anything to add on that, Kristen?
So I think that's a really good key point to show that conventional, you have something as low as 3%, because a lot of people are discouraged sometimes from conventional loans because of the higher down payment. So that's really good.
Yeah, good point. I mean, most people, if we survey folks, they think you need 20% down to buy a home, and that's absolutely not true. Now, with the 3% down, there's some things that come with that. You need that higher credit score, and if we can't do that, there's the FHA loan, 3.5%, is always a great option.
Pete, just really quick. I'm sorry, just really quick. Can you just touch a little bit on the main difference between FHA and conventional?
Yeah. The process is pretty much the same. You got to qualify credit, income, and assets. Typically, FHA will allow more leniency in credit. Okay. So if somebody has lower credit scores or thin credit, we find with a lot of first-time home buyers, it's not that they have bad credit. They have little credit, or sometimes once in a while, I'm glad you brought that up, they might have no credit. And we could actually do what's called a manual underwrite on an FHA loan with someone with no credit. We have to have some alternative trade lines and stuff, and hopefully they pay rent and prove out some things. But with conventional, that's not available. Typically, you got to have the higher credit score. The other big difference is with FHA, if someone needs to stretch what's called the debt to income ratios, we can do that on FHA higher than what's allowed on a conventional program. And so the main thing is that it's easier to qualify FHA versus conventional. Okay.
Yeah, thank you.
So let's talk about, just on a high level, what the main 5 keys are to home ownership. I'll read through this and I'll just make a couple statements on each. So job stability, credit history and score, which we touched a little bit about, but I'll add some stuff. Available assets, income and debts, and then home qualification factors, which really is the appraisal piece and all that, which you can't do a lot on that piece. What you can control really are the first 4. So these are the main pieces. So job stability. Now, we definitely need somebody to be employed to get pre-approved and purchase a home. There are some misconceptions on, what job stability actually means. A lot of folks think that you have to be on your current job for 2 years. I've heard that a lot. I don't know. Have you heard that with people?
Yeah, I hear it all the time. At least 2 years.
Which is 100% myth. Okay. So while we require a 2-year job history, it doesn't have to be on the same job. We just say, well, what is your last 2 years job history? Now, having said that, there are a couple things. If someone's had 4 or 5 jobs in the last 12 months, we must have them be in their current job for at least 6 months, because there's a little bit of instability there. But you could have worked for, we'll just say you were a Target store manager, right? And for 5 years, right? And now you just went over to Kohl's as a higher area manager, and you just started a week ago. We can do that. There is no have to be in 2 years. So that's a very important one for you to, when you talk to folks, is you don't have to be in that job that specific job for 2 years. Make sense?
For sure. It makes a lot of sense. Thank you. I
Perfect.
like that part of it.
Perfect. Okay. So credit history and score. We talked a little bit about, FHA being more lenient, and I'll just touch on a high level. We have programs that have credit scores down to 580 now on FHA. Having said that, it is more difficult to qualify for a loan with a 580 credit score, right? The higher the credit score, the better. Credit scores work in tiers of 20 points. So 580, 600, 620, 640, 660, 80, 700, 720, and anything above 740 doesn't matter. So if you have a 741 or an 800, you're in the same bracket, okay? Now, these different brackets here serve a couple purposes. One, the higher bracket you're in, the easier it's going to be to get pre-approved. Also, it's going to determine your pricing of the loan, so your rate and what fee for that rate. So that's kind of a little bit there. We talked about FHA. We can do limited credit, folks. So with conventional loans, you got to have a thicker credit file, so more credit than you would have to have for FHA. So there's a wide range, but you definitely need to have some type of credit history for a conventional loan. With FHA, we can get into that that scenario where we do alternative credit. Okay, makes sense, like rent, utility bills, things like that. Okay.
Okay.
All right, excellent. So available assets. Here's we touched upon that, right? We said there's a huge myth out there that you need 20% down to buy a home, right? Back in I think in my parents' age, it was, and beyond that, and grandparents' age, they had to, I think, back in the early days of mortgages, I think it was you had to put down 50%, right? And they're like, well, we're giving you this loan for a long time on this house thing. You need to put down 50%. Well, obviously, things have come a long way. FHA has been in place for many, many, many years, 40, 50 years. And so the low down payment stuff is available. So the 3.5% down, the 3% we talked about, conventional. But let's focus on the asset piece. So available assets, obviously the easiest one to identify would be, what do you have in checking, savings, CDs, mutual funds, things like that. The other one that a lot of folks have, depending on how long they've been at their job, is their 401k plan, right? I do have lots and lots of buyers that will take a loan from their 401k plan, right, to use for the down payment. You can do that. Lots of people, do you have people that didn't know that, Kristen, that they can borrow from their 401k?
Yeah, I did have a client that didn't know, and she's looking into it as we speak. So that's something that a lot of people do not know about. So I like that piece as well, to kind of educate people on just something so simple that they're already paying into.
Perfect. And the cool thing about the 401k loan, you're actually paying yourself back. So with the 401k, and you're paying yourself interest back. So it's like an interest-free loan to get into a home. The other thing where it may not be available at the moment, the asset, these lending programs allow for gifts. Lots and lots and lots of people don't know that they think they have to have the money right now, right here in hand. They don't. Now, you have to potentially have a family member that likes you. I can't guarantee that, right? And I tell people, it's, look, everyone's situation is different, but look, there are lots and lots of folks that they have the good income, but they don't have that down payment. They just don't have that one-time influx of cash, right? And they do have family that like them. Their mother, father, brother, sister, grandparents. Grandparents are a great example. that have done well, and they're like, they're done vacationing in the Bahamas, and they're like, hey, my granddaughter is looking to buy a home here. I will give her $20,000. So these are questions that we need to ask. Obviously, we need to be a little sensitive and not say, hey, can you at the next family party just raise your hand at Thanksgiving and ask anyone, if they'll give them money. Let's be a little smart and just I always approach and say, well, what are your thoughts on down payment? And are you aware that you can get a gift from a family member? Do you have clients that have known that?
Not necessarily. I think that that's something that more people can be educated on, because like
Right.
you said, most people think that you have to have it right away. So,
right. And the cool thing is,
maybe in that situation.
yeah, absolutely. And the cool thing is we don't have to have that money until the closing. They can actually wire transfer it to the closing. So it never has to be something that is a big deal that has to show up right now. We just need to know that that person will sign a gift letter and that money will show up at closing. So it's pretty easy. We do it quite a bit.
Okay. So that's what they need to sign to kind of guarantee that they will have it, is a gift letter.
Yeah, it's a standard gift letter. It's a 1-page form. It's very, very, very simple and standardized. So
Okay.
So yeah, that's something to talk to your clients about. A little talking point you get out there, and as you post stuff out there.
Okay.
Let's talk about so assets. You can build assets over time, I guess is the point. So that's fixable, right? Now, let's talk about the income and debts. We talked about job stability. As far as income and debt, and how that relates to the mortgage programs, it's not always about having that great score. You also have to have the technical term is ability to repay the loan, right? Okay. So we'll do a calculation, and there's 2 ratios that we look at. We call it the front end and back end. Front end ratio is the housing payment. So the total payment for your mortgage, let's say that's going to be $2,000, right? Principal, interest, taxes, insurance, and mortgage insurance, right? Mm-hmm. And then let's say you're a normal single person or family. You have 1 car payment. You might have 2 car payments, and you have some credit card debt. We take those monthly payments, add all that together, and that's how we come up with your debt ratio to determine your ability to repay. And there's some debt ratios that we have to stay within. FHA, I was telling you, that's more lenient. You can do up to 57% of your gross income for all your debt, which is a substantial amount, Yeah. So if you make $10,000 as a couple, you can have $5,700 going towards mortgage payment, car payments, student loans, credit card debt, any other debt. This doesn't take into account utilities or anything like that. It's just everything that you have on your credit. Okay. So does that make sense?
Yeah, that makes sense. It's good to kind of have it broken down a little bit more on
okay.
The
Perfect. Yep. I wanted to talk about one of the things that's front and center in the news right now is student loans.
Yes.
Obviously, we're hearing a lot about that, and something's going to come out in the next week. But I think that amount, it's $10,000 or $20,000. I mean, I have clients. I mean, that really isn't going to solve everyone's problems, right? It'll solve, people that have what I consider a small amount of student loans, right? I would. Are you sitting down or are you standing up? Because you might fall down when you hear this.
I'm sitting down, but let me hear what you got.
Okay. So I have had clients that have had over $500,000 of student loan debt.
Wow.
Ouch. Right?
Yeah. That's
painful, right?
Yeah.
And look, that's not the norm. I have had multiple clients in the 200,000 plus, lots in the hundreds. And then most of them fall in what I would say $75,000-ish range, right?
Yeah.
Now,
I know.
let's say somebody is $75,000 in student loans. And right now, those student loans are in forbearance, so they're not paying them back. But what happens is we have to count some of that towards their debt. And the standard formula is we take half a percent of the overall student loan. So 1% would be $750 a month. Half a percent is $375 a month for FHA loans. For conventional, we would take $750 a month and count that against them. Now, we've gotten pretty smart at the student loan stuff. People can get into, have you ever heard of income-driven repayment?
Yes.
I think you and I are working on a client like that, right?
Yep.
So perfect. So you know all about it. And that would help somebody based on their income. Let's say they have this $75,000 of student loan debt. Their income-based repayment amount sometimes is $50, $75, $80, a lot smaller. So that would help someone qualify. I don't expect clients to know that, but this is something that you can upfront. There are lots of people that come in and say, "Oh my gosh, I can't. I'm not going to qualify for. I have all these student loans." Well, there's solutions for that. Okay, does that kind of make sense in the income? I don't want to get too in depth with how to calculate income. That's us, self-employed people.
Yep.
We have to average their income, and we average bonuses and commissions and stuff like that. But I just wanted to get out there that basically we'll calculate your income, and kind of when we pre-approve you, we'll let you know what your maximum is based on your income. Okay.
Absolutely. Okay.
Any other questions or comments on income and debt?
Nothing I can think of. I think you covered pretty much all the questions that I usually get asked. And so
Awesome.
That's pretty much it for that part.
Okay. So I apologize for it not fitting in the home qualificat. I own factors. So it's home qualification factors. So that really is, there's different properties and different conditions of property. And you're pretty well versed in this because you've done some fix and flip type stuff. So you know all about this. The home, first of all, the home has to appraise for what you're buying it for. That's the basics there. But I want to talk a little bit about the home conditions and all that, and what potential solutions we at Homebridge have, and you as a renovation expert, can also talk to. So we do, having said that, we do condominiums, townhomes, single family, 2-unit, 3-unit, and 4 units. Those are the property types we can do, right?
Right.
So we don't do commercial, and we can't do, I've had someone call me, they want to buy a 6-unit, 8-unit. I'm sure you have investors on that. Yeah. These programs don't fit them. That's a commercial loan. So let's talk about property qualification. So if the property appraises and the appraiser doesn't mention anything that has to be repaired, great. That property is move-in ready. Sometimes the appraiser goes out there and says, wow, gosh, they don't have the, I just had one, what do you call those things? The GFI outlets, right?
Yep.
By the sink
or in the bathroom. Yeah.
Right. So they'll flag that. That's a very minor thing to fix. So sometimes it'll be where there's a home available and you've seen them out there and it has been vacant for years. It might've been a foreclosure. And at the end of the day, half the place is gutted, or there could be mold in there.
Yep.
The roof needs to be replaced. You name it. The bathroom's torn out. We at Homebridge can do that loan still. We can do what's called a renovation loan. And we could certainly help. What we would do is qualify that person for the purchase price of the home, or 2-unit or 3-unit or 4-unit, plus that renovation money. So, and we do projects I do renovation projects that go up to $300,000 in work, $350,000 in work. So yeah, certainly it's something we can help out. We can help out with if the home doesn't qualify right up front.
Okay.
Any comments or questions on that?
Are there any things that can be wrong with the home that you all would maybe deny the loan for, or if it was just too much work, like if it was just in very, very poor condition? Is there anything that would kind of disqualify a home?
Not necessarily, because we can do up now. I would say up to the loan limits. You know, we can do projects of if a home needs $300,000 of work.
Right.
You know, we can do that. We typically don't like to go if there was a home that needed $500,000 of work, that would be difficult. But we wouldn't deny the home. We would require that it be a renovation loan. You know what I mean?
Okay.
But you can fix anything you want on the home as long as you qualify for the dollar amounts. You're good to go.
Okay. Good to know.
Awesome. Okay. So obviously we talked through this, you know, job history, you know, multiple job changes, you know, employment gaps, you know, the credit scores. I think we talked about 580. You know, the one thing I want to mention here is there's differences between, you know, what a consumer credit score is versus a mortgage credit score.
You can give me a quick definition of it, because I do get that asked a lot sometimes.
Yeah. So everyone, you know, what I would ask somebody is you know, a lot of people know what their credit score is, and you can ask them, well, where'd you get that credit score? And most of them are going to say, well, Credit Karma told me. Okay. Credit Karma is a consumer credit score. It doesn't translate well to the mortgage score. So if somebody's like a 650 on Credit Karma, they'll probably be a 610 on a mortgage score. So something, you know, if you come across that, you always want to lead them to Equifax is a good resource, Equifax.com, and they have a mortgage. In one of the sections, you can click on mortgage score. That would be, yeah. So that's helpful information to tell folks if they could simply call me and we'll look at the score and we'll come up with a plan together. And you can tell all your clients, right? You have a family friend or a family member that can help folks with some credit stuff, correct?
Yep.
And that's a great resource for anyone out there. Absolutely.
We've worked on a few, and we've got some people that we're working with now, so that are ready to buy.
Yeah, perfect. So anything's fixable over time, right? Unless that person doesn't do anything about it, right?
And that's the key, just being proactive about it, because a lot of people may have credit issues. However, it does take some work, and if you're willing to put in the work, you'll be in your home sooner than you know.
Awesome. And credit history, just to expand on that, and what the credit is determined by. This is just a little table of payment history is the biggest one, 35%. The amount owed is 30%. That's another huge one. So you can change your credit pretty rapidly. I'll give you an example. If you have $1,000 credit card limit and your balance right now is $900, and you bring that down to $300, you will bump up your credit score immediately. Okay. So rule of thumb is you want to be like at 30% of the high limit. Okay. 15% is the length of your credit history. So if you're young, the younger you are, the shorter the length is going to be. 10% is what's the new credit, recent credit. And then the last one is types of credits, you know, mortgage, installment, revolving, stuff like that, your mix. Okay. But the biggest one you can affect is this amount owed. You can certainly bring down the balances and your score will go up immediately. And the cool thing is it works on each card. So if you had a $10,000 credit card or a $1,000 credit card, and you didn't want to pay that big amount, you can just do it on the smaller one and bring that down to 30%. And that'll give you the same points as if you did it on the big credit card. I know a lot of people don't know that.
Definitely. Yeah.
So that's a good, and we have a program we can run to help people, and it's free. Just run it real quick and see how they can bring up their credit scores. Okay. If they can't increase their credit scores, then back to you, to the expert to fix the credit. That's what I suggest. And then we'll keep in touch and get them ready in a few months.
Okay.
We didn't touch on there's the significant events, which bankruptcy, collections, judgments, tax liens. So bankruptcy, everyone knows what a bankruptcy is, and people think that they cannot buy a home if they had a bankruptcy, or they think it's 10 years, 7 years, all kinds of different answers. It stays on your credit report typically for 10 years. Now you can get into an FHA loan 24 months after you have finished your bankruptcy. So it's not that long of a waiting period, right?
Right.
24 months. Collections and judgments. We can do loans if people could say, well, I have these collections, I have a judgment. I can't do a loan. You can, we just have to figure out how big are the collections are, what we have to include, what we don't have to include. Okay. Tax liens. Lots of people think they can't buy a home if they have a tax lien. That's not true. You just need to be in some type of payment plan. That's it, and then we could show them how to do that as well. Okay. Available assets. So we talked about savings is the biggest one, checking savings. The one thing I do want to mention is any amount that just shows up in your account besides like your normal paychecks, you do need to what's called source that and season it. So I don't see that it says sourced in here. Season typically is 2 months. If it's in your bank account already for 2 months, we're not going to ask, that amount is that amount. But if $10,000 is dropped into your account and it's not a paycheck, we would ask, if you're going to use that money, we'd ask, well, where did that come from? Okay. Does that make sense?
Yeah. And we get that a lot of times throughout the entire process. So when things come up, just know that the lenders are working hard just to kind of delegate the tasks that they have to do to see where things are coming from. So that's
exactly. And we talked about gift from a family member is acceptable, right? Oh, the one thing I'm glad this is on here because we didn't talk about it. And Kristen's a great realtor. Obviously, you folks all know that. She will negotiate depending on the situation, how competitive, right, the market is, or that particular property. You can negotiate some seller closing cost credit, right? Yeah. You'll determine that, and we can use that to offset all the loan closing costs. The person still has to have a down payment, but we can have the seller pay all the closing costs. Does that make sense?
Yep.
Perfect. And I'm sure you've done that many times. You can negotiate the right price and say, hey, my buyer needs $5,000 for closing costs, right?
Yes.
Cool. Income and debts. We talked a little bit. Oh, there's a couple things on here. Two things I want to mention. So child support is a big one that it works. It can work double-edged sword, right? Child support. If you're the receiver on it, you can elect to use that as income as long as we can document that that's consistent. If you are the payor of it, so if I'm paying it, then that counts as a debt against me, right? Into my debt ratio. Make sense? So it's kind of a whatever side you're standing on, receiver or the payer, it can affect your income. Now you do not have to reveal child support that you're receiving if you don't want to. Consider if you qualify without it. But it's sometimes that's the difference between qualifying and not qualifying, right?
Yep, it could help.
Right, exactly. The other one is Social Security disability income. I love working with veterans. I don't know if you have any veteran clients. Lots of them have get VA disability, which sometimes is very substantial income, right? In addition to if they're working, or I have a gentleman that he gets that and another small piece of income, and he qualifies with that disability income. So all types of income we can use to qualify. And we're the experts at it. We'll let you know. We'll ask the right questions and hopefully qualify your folks. Any questions, comments on that?
No, I think you covered everything on that
Awesome.
part.
We talked about the home qualification factors, and then here's a simple formula of what the components are. We talked about principal, interest, taxes, insurance, and mortgage insurance. So this would be a $237,500 loan, 4% interest rate. The property taxes are $6,500, and the homeowner's insurance is $1,200 a year. This is how a typical payment would break down. So on that property, you would be looking at $1,837 or so. Principal and interest, you can see that component. We're lumping taxes, real estate taxes, and homeowners insurance, and then an estimated private mortgage insurance amount per month. So those are the components of a mortgage payment. One thing I do want to point out, that when somebody's looking to qualify, we like to give them this. We like to work backwards and say, you qualify for a $2,000 payment. Okay, does this property work? Does it fit? Because as you know, the taxes, real estate taxes are crazy out there, right? Cook County hasn't even issued theirs yet, right?
Yep.
So what ends up happening is those real estate taxes on a property, I could tell you this, $300,000 property, real estate taxes can range from $4,500 to like $15,000, right? You've seen the wide range, right? You work the Chicagoland area, correct?
Absolutely. So it can go up.
Yeah. So you'll know. So what we like to do is we like to arm the buyer and you as the agent with that payment total. And I also help, I have some nice calculators on my website that you can do the math right away and qualify that property. Make sense? Because not all properties are going to have the same payment. It's not just, I don't like when loan officers or my competitors out there say, well, they qualify for $325,000. That's not true. Based on how much real estate taxes, right?
Absolutely.
If you change those taxes to $15,000, they might not qualify for $325,000. They might not qualify at all.
So yeah, that's why I just want to add in for clients, new clients, or present clients, is that your loan is all going to depend on the property that we end up finding, because it can change. We can look at a house that the taxes may be a little lower, and then we find another house where the taxes may be much higher, and that can kind of shift the numbers. So I do like that breakdown.
Perfect. And so at the end of the day, why Pete and Kristen? Because we are the best, right?
Of course.
One thing I want to mention, it's good to have a good working relationship. We're about doing what's best for the client. And, you have a great range of knowledge, especially in that renovation area and working with first-time home buyers and second-time home buyers. We can, with my pre-approval and your expertise, the folks can go out and look at all the properties, not just stuff that's move-in ready, right? So we can open up lots of options. I also like to, with my pre-approval that you would have, they can bid on properties that are move-in ready, properties that are fully gutted already. It doesn't matter, right? So that's why I like to say that my pre-approval is a little bit better than, Quicken Rocket Mortgage's pre-approval. I would like to say that mine's mine has some more options. Okay. So really just a little bit about Homebridge and how it would work. We're a national banker, so we do everything in-house with Homebridge's own money. So we don't need anyone else's approval also. So and I've been doing this for, I guess it was 20, I thought it was 29 years, 28 years. So long enough to have seen just about everything. I'm not saying everything, but pretty darn close, right? And then I think we've touched on all of these conventional FHA, VA. We talked. You don't do any USD, the USDA, the rural loans. Do you do any of those?
I haven't quite yet in my career. I haven't yet.
So when you get out to where there's just corn and stuff, cornfields. So if you take I-80, start headed to Iowa, or I-88, and there will be some areas that qualify for the USDA loan, and that's one that you can do 100% financing as well. We also do. I know you're an investor and you can help investors. You and I actually did an investment property for a client.
Absolutely.
We can help investors. Obviously, we're talking about purchase transaction. We obviously do refinances. We do jumbo loans. So anything, if someone's looking for that dream $1 million, $1.5 million, $2 million home, we can accommodate there. We talked about our niche program, the renovation loan. I love the renovation loan. That's really about it. In terms of the programs, anything else that we didn't touch on, Kristen, that you want to share with the folks, and then we'll wrap it up. I don't see that there's any questions.
Yeah, I don't see any questions in the comments, but I do want to say, I just want people to stay encouraged. Through a lot of people are kind of getting discouraged, Pete, with the interest rates. We have the lender here, so what's your input on that? Because a lot of people see a shift. I'm obviously trying to keep clients encouraged, but any tips on the shifting market, if you would say there is one?
Yeah, 1,000%. I got a couple things to say. So good news is we stay in touch with all the economic experts in the entire world. I mean, because our company is gigantic. We have those resources. So we can't see 5 years, 10 years into the future, but we can actually see a year or 2 years or 3 years in the future, believe it or not. A couple things to note. People have gotten discouraged because those prices of homes had gone up so fast. In just a few months, right? So at the end of the day, we still feel that homes are going to appreciate. So one of the big things you'll probably see that people are discouraged are like, I'm going to wait until the prices go down, right? You get that all the time?
Yeah, I do. I do.
So anybody that's going to listen to this webinar, if they can take away anything, that is absolutely not true. Okay. They're not going to go up as fast. I have economic charts to prove this and stuff. So homes are still going to go up. They're just not going to go up as fast. So if you stay renting right now and you could have bought a house for $300,000, you would have gained another in a year $15,000 of equity on that home. Yep. What'd you do about renting? You didn't gain anything. Okay. So that's a big one that you need to share with your clients. Go, hey, Pete and his company said that the price, they're still going to go up, just not as fast. You're not going to see the home go from 300 to 375 in a year. That is gone right now. Okay.
Absolutely.
But it's going to go from 300 to 315 to 330, and so on and so on. The second thing about interest rates, right? We strongly believe that within the next 9 months, 10 months, 11 months, rates are going to come down by, we think, by 1% or more than where they're at now. So we believe the rates are going to stabilize in the 4s somewhat, okay? Which is positive for next year's business, right? That people aren't ready to buy right now. Don't lose faith. Rates are going to come back.
Okay.
The other thing too is to note, in this environment, we talked about this renovation loan. There's a perfect opportunity to take advantage of homes that are not in move-in ready condition and get that instant equity. So if you bought something for 200, put 100 into it, it may be worth 370 at the end of your project. That's a home run. That's a way to take advantage of something in this market. The other thing I think we're going to see is there's going to be some foreclosures that are going to be hitting the street with all that moratorium that was on there in 2020 and 2021. You're going to see, as a real estate agent, some inventory being released. So it's going to be a good opportunity for first timers to take advantage of those not so pretty properties. But look, you can make it your own. So those are my global takeaways in what to tell people. Look, don't be discouraged. Don't buy just because somebody said the interest rates are high.
Yep.
That's not a good reason.
Yep.
I mean, you can't tell your spouse and children, hey, we're not going to buy a house because interest rates are high. We're going to buy. We're going to do the best we can in this situation. And we're here to help and figure that out, right?
Yep. Okay.
So those are my last 2 cents.
Okay. Well, yeah, I get that a lot. So that's why, we just want to strive to continue these educational webinars just to kind of open up the platform for people that may have questions, because I get it all the time. And it's good hearing it from a market expert. Yeah.
Perfect. Well, I appreciate all your time and the folks that joined us. I know it was a long one, but lots of information here. I think we're going to continue to do these, and you and I will brainstorm and do some fun ones where we could share some specific, I guess I would call them success stories, and start to build on that, and really, I guess, put our money where our mouth is, in terms of show people that we actually do this and what kind of success that clients can have, especially in the renovation game, right? We can show some results, and I think people are afraid, but I've done so many of these projects. You've done some personally, that we'll try to share some more specific information, right?
Yeah, absolutely. I'm looking forward to it. Thank you so much for your time too.
Thank you, and happy Friday, everyone. And we'll meet again here soon on another webinar.
Sounds good. Thank you so much, Pete.
Have a great day.
Thanks everyone who tuned in. Okay, talk to you soon.
Thanks.
Thanks. Bye-bye.